Thank you, Sri. I'm Samuel, an investment analyst with Phillip Futures. So on the day, today we'll be actually covering the drivers and opportunities in the US stock indices and US dollar currency futures. So just a little bit about myself before I go into the topic in proper. Okay. So for this seminar, uh, it's only for solely for education. Every form should be taken as before making any decisions, please consult the relevant people in charge and do it according to your risk profile. A bit about myself, I'm an investment analyst with Phillip Futures, so I specialize in the equities, indices, and forex market. All right, so on a day-to-day basis, I actually provide daily commentaries on indices and future and forex to our clients, and I'm also a market commentator. So you may have seen me on TV before, saw my reports or commentaries on the newspaper before, or even heard me on the radio before as well. So I also do conduct seminars. So some of the larger scale seminars I conducted will be the Invest Fair in 2017 and the Lianhe Zappa Forum last year itself. So for the seminar as a whole, we'll be actually covering the major themes that affect global markets last year itself, followed by the overview of 2018 for the US market, as well as our view and forecast for the first quarter of 2019. Lastly, we will share how to partake in market action using futures. So before we begin, I'd like to ask everybody is how is markets now? So in 2018 itself, we actually saw markets reach a peak, and many people are left flustered, not knowing right now, is it the bull is going to carry on or the bear is going to strike down next? So regardless whether you are bullish or bearish about the overall economy, what I sincerely hope that everybody is not is that you do not be a sheep. Because as long as you have a view, you will not blindly just follow people and you may not get slaughtered. All right. So personally, we have the view that right now we may be just at the last bull market and the bear may be able to strike it at any point of time. So we can see that if we are at the last stretch of the bull cycle, usually the rises are not as sharp as last time, and you can see a lot of volatility, which is what we saw in most of 2018 itself. 2018, two teams actually move markets, and if you look at major newspapers or in fact major reports, they have been constantly publishing about these two events. The first is the trade and global tensions that actually struck global panic into many investors, and the next is actually the rising interest rate environment. So we all know that actually right now there has been three waves of tariffs being announced and actually implemented by the US. So just to simplify things, on the third wave is actually split into two parts. The first is a 10% and subsequently they want to raise it to 25%, right? So far, the 25% one is on hold, right? And but nonetheless, out of all the three tariffs, the third tariff is actually the one with the most impact, and we have yet to see the full impact on global markets. So the latest update is actually that the US will hold off raising uh, the tariff rates to 25% on China, even though it wanted to do so starting from January, and they agreed to a 90 days trust to actually sort the matters out. However, my question that I would like to pose to everybody is, do you think that the issue can be solved in 90 days itself? So that is the big question that is actually weighing on current markets right now. Even though China has came up to say that they are confident of striking a deal in 90 days, personally, I'm not so optimistic. So we can see that based on the tariff so far, the third wave is the one that impacted market the most, and we have yet to see the full brunt of it in the economy because it was just implemented about a month ago. Whereas we can see that from the first and second wave of tariffs itself, the economical impact in regional economy and Chinese economy is quite huge. And so when people talk about resolving this whole trade tensions, people must look at the underlying root of the issue itself. So we can see that the fundamental issue, which is the trade deficit, actually remains unresolved. because there are only two ways to actually solve this deficit issue. The first is for China to actually reduce the amount of for China to actually increase the amount of US imports, or the next is for actually US to reduce the amount of Chinese products. So China does want to import more from the US, but the US actually does not want to sell China what it actually wants. So what does China want is actually the high technology products, but the US is worried about IP infringement. So what does the US want to sell to China? They would like to sell them airplanes as well as agricultural products. But for a particular country, there's only so much that they can import from the outside before they actually reach a threshold, because if they actually import more, they may sort of like tip their own economy off equilibrium, and it will cause an oversupply, and this will actually result in another problem of its own. And that's the reason why China has refused to actually import much more than it already is. Whereas for the US side, US is not able to drastically reduce the amount of Chinese imports. Why? Is because China actually import low end products, meaning to say the cheaper products to US itself. And if they were to reduce the imports they have from China, it will actually rise the cost of living in the US itself, and that will actually cause inflation to rise and the citizens to feel unhappy because they no longer be able to purchase that many products as they were last time. And cutting the amount of Chinese products also limit the user's choice as well. So all of this actually cause both sides to not want to uh both sides to were unable to resolve the problem as they were unable to come to a consensus of things. So right now, with a tight deadline of 90 days, it's quite difficult for the problem to be resolved as well. And we can see that the trade balance has been increasing over the years. And since March, whereby they first started about the talks, and they said that they want to put tariffs on each other, you can see that the trade balance actually reduced, but subsequently right now is back close to the March levels again. So we can see that not much continuity in the improvement was actually observed. So if you look at the trade deficits between US and China over the years as well, we can see that it has been increasing year on year without fail, and going forward, it may pose that much of a problem as well. And that's why with the current tariffs, we can see that even though the tariffs actually kick in June and July itself, the trade imbalance have still been rising. So are tariffs the way to solve issues? That's the question that not many people can answer and are still posing as well. So with tariffs actually in place, not only are the US and China affected itself, but the entire global economy is impacted as well. Why is that so? Is because it actually involves global trade. China is a huge importer as much as it is an exporter. It imports the raw materials or intermediary goods before actually assembling them and shipping them to the US, etc. So with a reduce in Chinese demand, what happens is that China will reduce its demand elsewhere as well. And so globally, with all these trade tariffs and trade barriers in place, we can see that trade has started slowing down, and it has caused a global economy to slow down as well. So you can see agencies like the IMF, like the OECD, cutting global growth forecasts, and it is actually cutting 2019's global growth forecast as well. So all of this actually not very good for the global economy. The next is the rising interest rate environment. We can see that rising interest rate environment actually resulted in a huge sell-off in indices as well. So like if we look at the sell-off in February was due to a rising interest rate environment. So we must understand that there are two basic products that people invest in. The first being equities and the next being bonds itself. So when people decide, or investors, when they decide where to park their money in, they'll look at where give them the best returns. So if interest rate continuously rises, what happens is that the risk-free environment becomes more attractive than the equities market in terms of the risk to reward ratio. And you may see an outflow of funds from equities to maybe bonds itself. And that's what actually caused the sell-off or the panic sell-off in this year. You can see that US Treasury yields actually peaked this year itself, showing that we are in a rising interest rate environment and that people are actually shifting their funds away from equities as well. And this actually weighed on markets. So moving on to the US in particular, before we actually progress, we will actually say the difference in the four indices that are actually available in the US. So if we look at the S&P itself, which is the one made up of 500 large cap stocks, it's one of the most popular futures indices that people actually trade. Why? Is because it's well rounded and it's more sensitive to tax cuts as well as energy deregulation. And if we look at the Dow Jones is more weighted on the financial side, and it's more sensitive to sort of like your financial deregulation, healthcare regulation, infrastructure, etc. Whereas for the Nasdaq 100 is the technology stocks. So if right now we can see that in the US side, the bright spark is still the technology sector. So because of that, we can see that the Nasdaq actually performed quite well among the other indices this year. And the last is the Russell. So the Russell is actually similar to the S&P, but the S&P is made out of large cap companies, those bigger names, whereas the Russell is more of the small mid cap stocks. So it's more volatile, and people who prefer volatility usually Russell index itself. So we can see that based on this year till the 5th, which is 2 days yesterday itself, you can see that the Dow actually only increased around 1.5%, where actually if we look throughout the year, the on 5 to 6%, but over the recent times it has actually declined back again. And if we look at the S&P as well, the S&P also rose around 1.25%, while the Nasdaq actually rose 6.52%. The outlier will be the Russell, because it's the small caps which are more sensitive to negative news. See that it fell around 5%. Well, so what are the factors that impacted US sort of like affected US itself in 2018? So we can see that these three factors, what happened. The first will be the normalizing tax cut effect. The second will be the start of the new Fed chairman, and the last will be the improvement in the US economy. So we can see that the first two factors are more slightly negative, whereas the last factor is slightly positive, and that is what actually gave the rise in US indices, the last factor. So for the normalizing tax cut effect, we can see that actually indices sought in January and February, in January itself, because late last year in 2017 in December, President Trump gave a late Christmas present and he actually announced the tax cuts. So the tax cuts actually benefited companies, giving them more revenue. And so when earnings were released in January itself, it actually beat expectations and markets sought. However, we noted that the tax cut effect actually lessened over the year. Why? Is because markets are always very forward looking, so they tend to price in these tax cuts. So maybe the first quarter, which is the fourth quarter 2017, they did not price in as much, and then it beat expectations. But subsequently, when they start pricing in, when it beat expectations, it didn't beat by that huge a margin as it did. And by this quarter, which is their third quarter reportings, we can see that some companies actually already fell below analyst expectations, and this resulted in the drop as well. So with that in mind, we can see that going into 2019, this tax cut euphoria may no longer impact markets as severely as it did. You can see that in this year itself, we saw the rise of a new chairman as well, and this actually gave rise to interest rates rising. So Powell is actually much more hawkish than Yellen. So during his first FOMC meeting as chair, what happens is that he already stated that he wanted rate hikes into 2019 and 2020, and it shows his hawkishness. He actually, because of this, he actually went into several clashes with President Trump over the year, whereby President Trump actually stated that Powell is actually raising interest rates, impacting markets, that is he's not supposed to raise rates that quickly, and that he actually disrupted the tax cut effects, etc. But on a Fed perspective, it was necessary to curb over the economy from overheating as well. But of recent, what happens is that he has toned down his speech slightly already, and I will further elaborate that in my later points. So the last one is the growth spurt that we observe in the US side. So there has been a drastic improvement in US economy this year. We can see unemployment rate falling to a 49-year low, which we deem as really an all-time low. We can see that GDP has also been expanding since 2009, which is the third longest period so far. And the PMI numbers have been in expansion as well. So all of this positive data has been actually pushing US indices higher. It's been giving confidence to the US market. Of course, another factor will be the tech industry as well, which still outperformed and has been doing well this year. So we can see, like stated, unemployment rate is at all-time low. GDP growth is still expanding, and we can see that the PMI numbers, the manufacturing PMI numbers, in fact, which is President Trump's focus for the US economy, has been on the rise and has been continuously expanding. So all of these are very positive signals. However, going to 2019, we feel that the US, at least for the first quarter itself, the US may actually be bearish because of these three key points. The first is that the US-China relations are still rocky. And the second is that the trade tensions are expected to harm corporate earnings and forecasts. And the last is that the yield curve is actually inverting. What do you think? Do you think that right now they are able to resolve the dispute between US and China in 90 days? Like stated just now, we are quite pessimistic about it. And we can see that there have been various signals from both parties as well. Not only did sort of like they not have a joint statement, we can see that certain things that President Trump is saying, President Xi said something different. The latest is that President Xi is stating that he's confident that they will achieve something in 90 days, but if like there's nothing concrete, we can see that maybe President Trump strikes back again. So we can see that right now there are too many different versions of their so-called agreement on the market itself, and we have to wait for more clarity on things as we inch closer to the 90 days deadline itself. So from this meeting, actually the G20 summit that happened last over the weekends itself, we noticed similarities between it and the US North Korea summit a few months back, whereby you notice that President Trump tend to exaggerate his success. So we can see that in the US North Korea summit, he actually stated that it was a very successful summit and that they finally met, and same for the current G20 summit. But let's look at what happened in the North Korean summit. Until today, North Korea has not denuclearized, and it is after how many months of negotiation as well. So if we want China to actually conform to what US within 90 days is quite hard. Secondly, aside from the flamboyant style of President Trump, whereby he likes to say that it's a very successful, we noted that the incidents for the meetups are quite similar. Both had disagreements and both had their own stand on certain things. So we can see that President Trump and North Korean's Kim, they had a huge disagreement of denuclearization. And right now, they are still trying to solve our differences with no concrete answer yet, whereby there's no concrete solution. Second, if we look at right now, the G20 summit, we noted that in terms of fair trade, both President Trump and President Xi has actually has very different uh, definitions about it as well. So all of this actually adds up to the uncertainty whereby people are people are thinking that the China summit may actually end up like the North Korean summit, whereby they do not have a concrete solution after the whole thing ends. So we must look at it that there are many key issues to resolve as a whole. The first thing is the forced technology transfers in China, which the US on. So what is this forced technology transfers? The first, it means that whenever a US company would like to set up business in China itself, they would have to share their technology, of which China would have the IP rights too. So this is one that the US finds it very unfair, and we can see that one of the previous examples would be Ford Motors, whereby they went over to China to set up their factory and eventually got bought over. So the next is intellectual property violations, which President Trump sees it very severely, and we can see that this has been quite a known issue as well. So the cybercrime issues, which President Trump is accusing China of, and China has been denying, is also another key issue to be resolved. But the most important thing will be the Made in China 2025 program. So for the Made in China 2025 program, what it essentially means is that China will actually power itself to be a technology leader and and eventually become self-sufficient. So right now we all know that the US is actually a technology leader, and it does not want its competitive advantage to be taken away from it. And so with that in place, we can see that China, because the US has spent so much in terms of technology and afraid that China sort of like steals its technology, we can see that this will be a very difficult issue to be resolved. Trade deficit, as explained just now, the trade deficit has the key concerns in place with both parties refusing to give way. We do not foresee that it will be resolved anytime soon. So President Trump recently did state that China is going to reduce and remove all tariffs on US cars, which China has yet to confirm. And in fact, they are trying to play down this whole incident. So we can see that what President Trump is saying is very flamboyant. It's very exaggerated to some, and it may not depict the full picture as well. And from what we know on China's progress, China is not willing to take that much of a consensus as well, because if not, it's going to be literally at the beck and call of the US as well. So if we look at 90 days, whether is it possible, we look at the trade agreements that President Trump have actually succeeded in drafting so far. So very good examples will be the NAFTA as well as the South Korea US free trade agreement. So we can see that for both agreements, the US South Korea free trade agreement as well as NAFTA, both of them had a backbone to begin with, meaning to say that the first agreement done by the previous administrations is just an amendment. So if we look at the timeline needed to secure this agreement, it also took around for the NAFTA itself easily 4 to 5 months. So with a 90 days limit to draft a new agreement from scratch, it's going to be relatively difficult and surprisingly challenging for both parties to actually strike one. And hence, even though President Trump did state he could consider extending the deadline, uh, it does not reflect a very positive light on the whole situation. If President Trump eventually places tariffs on China itself, or actually if the agreement does not go well, what President Trump actually promised to do is he wanted to increase tariffs to 25% of all of Chinese. It will actually lead to major inflation in the US because it will cause the US goods to become more expensive. It could also lead to the Fed raising rates to curb inflation, and this will be a vicious cycle. If Fed raise rates higher to curb inflation, it will not be very positive on equities markets itself. And also, we will not see China taking this lying down. They will most likely reciprocate in other means aside from tariffs, because China has many ways of doing so. So China have recently stated that they will not use US treasuries as a hostage or as a weapon to actually strike back against. There are many other ways to do that as well. So we can see that actually you the Chinese is one of the huge spenders in US itself. So tourism has been increasing. People sending their kids over to the US to study has been increasing, and all of this have been contributing to the US economy. So if suddenly they would restrict their people from going to the US, or the Chinese citizens suddenly become afraid of going to the US, this will cause markets to actually retrace from there, because what happens is that there will not be as much spending in the US, and the US economy may not do that well. So another way is that the US actually has a lot of investments in itself. So China will be able to actually tweak its ruling or its rules to not be that advantageous to US, and because of that, it may affect corporate earnings. So we can see that China has actually used these methods before. It has done so on Taiwan, and earlier this year on uh, South Korea itself, because of the THAAD missile issue. So all of this has actually impacted tourism in those countries, and it resulted in their GDP shrinking during that quarter as well. So I mean, if China really were to implement such ruling against the US, we would think that it may affect US in more ways than another. So the trade tensions has actually also caused companies to be more jittery, to be more cautious. So as the earnings seasons kick off last month, what happens is that many companies actually shrink their forecasts. They actually gave warnings. So all of these are going to impact the 2019 numbers. So we must understand that tariffs actually harm companies the most, because companies will be the eventual ones that are paying for the tariffs, and it will erode their profits and earnings itself. So it's not that the Chinese government are paying for the tariffs. The ones that are paying for it are the companies that are importing Chinese goods. So if these companies do not find a replacement quick enough, or they do not find an alternative, they would have to pay the tariffs. And relocating a factory from China to other places may not be that easy, because it involves many other different costs as well. Lastly, you can see that the U curve is inverting. So just to explain to you what is the U curve, the U curve actually is showing the various short-term and long-term US Treasury bills. So it actually shows the definition of the markets on interest rate or the economy as a whole. So when the U curve inverts, is actually a red flag that the economy may be heading into a recession. So a U curve does not indicate a recession, but when there is a recession, or when the economy corrects a lot, we will always notice that the U curve is inverted. So this is very important, and we can see it happening in 2007 as well. When the economy crisis occurred, the U curve is inverted at a point of time, and the U curve inversion started from 2006. So with U curve inversion starting now, markets will become more risk averse as compared to previously. So we can see that right now the inversion is from the 2 and 3 year to the 5 year U curve. So all of this showing that the short to midterm, there may be a correction. Of course, people may attribute it to the fact that it may be because the Fed may not raise rates that quickly already, or may reduce rates 3 to 5 years from now. But naturally, you would think that it shows their confidence of the economy as a whole. So with it being a red flag for recession, we must be more wary, and that the bull cycle may actually come to an end, and take more precaution instead. So if we look at the mini Dow futures, we can see that right now it's testing the 200 SMA again. So if it breaks below the 200 SMA, what it means is that it may sink into another bearish cycle. So we always note that the 200 moving average is always as a acts as a strong support, and the S&P has actually broken past it already. So markets are actually more wary at the moment. If prices continue to sink, it can show that a bear run may be replacing the bull run that we saw for 2017 itself. Nasdaq as well, we can see that a few crossovers are observed, and it's showing that it's more negative than what we think it is. And for the Russell is much more negative as compared to the others already. It has already sink past very low levels. You can see that the long-term moving averages of the 100 is also going to cross the 200 as well. So that shows that it's very it points to huge selling pressure, and that unless there's strong reversal signals, if not the bearish trend, it could be there to stay. So with us being quite negative on US indices for the first quarter of 2019, we are actually neutral on the US dollar. The US dollar had a good bull run this year. It strengthened quite a bit. And when we mean by neutral, we are meaning to say that though it's still positive for the US dollar, its strength may not be as strong as what we saw this year itself. And this can be due to three reasons. The first is that it's still a safe haven currency asset. So with so much more risk and volatility itself, people may still decide to go into the dollar and give it strength. However, there are two bearish factors coupled with it, which is that the Fed is no longer as hawkish as it was this year. And the second is that we are actually nearing neutral rate. So just to show, the Fed is no longer as hawkish this year. In fact, if you look at the latest statements by Powell, he's actually saying that right now the current interest rates is just below neutral already, and that because of that, he actually may not raise rates as fast as he did last year. So this came just 1 month after what he said last year itself. So 1 month ago, he was actually still very hawkish. He's saying that he may raise interest rates to levels that he may affect. But right now, he has changed his tone and became more dovish. So we can see that this is echoed by other Fed members as well. So we can see that interest rates is much closer to neutral, and that they will be looking at economic numbers much more closely next year itself. So it brings us to the point, what is neutral rate? So neutral rate is determined by the Fed and is set at 3%. So we note that right now, the interest rate in the US is around 2.20. And if we include the potential December rate hike into play of 25 basis points, we will hit around 10%. So we are only 2 rate hikes away from hitting neutral rate. And if we hit neutral rate, what will happen is that the economy must move at or must improve at a much greater pace than it already is, and must show stronger signs of bullishness before the Fed will actually raise interest rates even higher. So now the US economy is very strong. So if you want it to improve at a much faster pace, it's also quite hard. So as what the Fed members have emphasized, data will be of greater importance going forward if they would like to raise it much higher than neutral rate itself. So one of the key factors that people are looking at will be the inflation rate. So for inflation rate, we can see that numbers are quite good at the moment. It's above 2%. Because this is the Fed target based on its path to neutral rate. However, if it hits neutral rate, it may raise its inflation target to maybe around 3%, and this will be a much harder target to hit unless, of course, President Trump really raises tariff rates to 25% across the board. Then that will be a different story. But right now, if based on current situation, it's quite hard to hit 3% inflation, and with that in mind, it makes it even harder for the Fed to raise rates next year. So indicator that the Fed uses is the PCE, which is similar to the CPI numbers, but it excludes food costs as part of it. So we can see that it's closing to the 2% target, but if really nearing neutral rate and Fed raises its inflation target, it's even harder for or to even justify further rate hikes. So right now, we are of the prediction that in 2019 itself, there will most likely only be 2 rate hikes. In fact, future rate futures are predicting between 1 to 2 as well. So it's quite low at the moment. And but of course, there is still another factor that people are looking at, because if we see this year when they have a press conference after the FOMC meeting, is uh every 2 meetings they have one press conference. So it shows that maybe they can only raise rates 4 times this year, as seen via the calendar over here. We saw that they raised rates in March, June, and September. And why is the Fed rates only after FOMC meeting with a press conference? Is because they would be able to calm markets and explain their rationale for raising rates very clear and concise manner. So one thing to note is that from 2019 onwards, they are going to have a press conference after every FOMC meeting. So it increases the probability for Fed to raise rates as well. So we can see that maybe the factors, the Fed itself will actually be more scrutinizing the factors, and the policies may have a depending on how the economy is progressing, because it actually gives the Fed more leeway to plan their policies based on economic conditions, because they address the public after every meeting next year onwards. So in lieu of that, we still feel that the Fed, the US dollar still have room for growth, but may not be as strong as this year. And so when we look at forex, because if we are looking at currency futures, we have to understand what forex is. So we look at forex, we're actually comparing two currencies. So we're comparing a base currency to a counter currency. So like example, if we want to say that the US dollar still has strength, we'll compare it to one that relative currency itself. So like example, if we're looking at the EURUSD pair, we're actually buying the euro and selling the dollar. And so if we take dollar is going to weaken against the euro, all right, we will buy the EURUSD pair. If we think that the dollar is going to strengthen against the euro, we would sell it, all right. So if we look at the few major currency pairs, okay, we can see that one of it that people are interested in is the Great Britain pound against the US dollar. So we can see that Great Britain pound still has much more weakness ahead. Has been a huge loss of this year due to the Brexit situation. And right now, arrows are pointing that the hard Brexit may still happen, because May's Brexit plans is unlikely to be passed through Parliament. Looking at next Tuesday as the key deadline, and that if it does not pass through Parliament, then May even lose her seat as Prime Minister itself. So all of these are very crucial. Right now, she have not garnered enough votes. Her internal parties, external parties, and her opponents are all against her, and so and treacherous journey ahead as she head into the deadline next week. So much more weakness entails for the pound, and this will actually give rise to dollar strength. So we can see, if we're looking at the British pound futures, so it's comparing the pound to the USD. We can see that it's still on a downtrend, and we predict that it may even hit the Brexit low levels. Right now it's at 23.6% support, but once it breaks these levels, it may hit even lower. All right, and so moving on to the next currency will be euro. So if we look at the euro itself, the economic numbers have slowed down drastically this year. It was largely attributed to the rapid rising of the euro in 2017, and with it not being sustainable, it actually caused weaken this year. So the rapid growth pace last year also was quite unsustainable. So this year we failed to hit targets. This resulted in the ECB actually more dovish than expected, and instead it actually said that it will keep interest rate unchanged for a prolonged period. So right now, based on interest rate futures, maybe only at the last quarter or the end of next year will they actually consider raising interest rates. See that recent developments in the Eurozone actually deters the ECB from raising rates as well. First thing is that we will have a Eurozone election next year in the May period, which will give rise to some uncertainty. Second thing is that there's a political crisis happening right now in Spain and France. So France, we see a lot of riots actually happening, which caused many recent U-turns in policies, and we can see that Spain actually lost some of the key states that it had, which actually will delay its budget plans. Also, we can see that the Italian budget crisis has been actually weighing on markets, whereby we can see huge exchanges between Italy and the EU itself, the European Council. So even though right now Italy has actually given way slightly, but based on numbers, we can see that economic numbers are not doing that well for Italy as well, and it may be facing its first recession in 5 years. So all of this actually point to very much negativity in the Eurozone. So we can see that the euro is actually also on a decline as compared to the dollar. And the next support we are looking at is maybe 61.8 levels. So what we have covered so far for 2019 for the first quarter market outlook. For US indices, we're actually bearish on it because US-China relations are still rocky. There are also the trade tensions is also expected to harm corporate earnings, and that the yield curve inversion will be a key event to look out for. For the US dollar itself, we are neutral on it because it's a safe haven currency. However, the Fed is no longer as hawkish, it's nearing neutral, but it still has more upside potential when compared to currencies which are facing huge headwinds like the euro as well as the pound itself. But maybe as compared to other safe haven assets like maybe the Swiss franc or the Japanese yen, maybe it may not perform that well. So one way to actually invest in indices and currencies will be via futures itself. So futures contracts are actually derivatives. So they derive their value from the underlying asset. So like be it the currency or even the index. So they do not last forever and have an expiry date, but no worries, you can always roll the contract over. So they are leveraged, meaning to say that you only need a fraction of the intended exposure and you can sort of like invest your capital elsewhere as well. So it's could be considered a slightly lower cost. However, do note that leverage amplifies both profit and loss, so it's slightly risky as well. Lastly, futures actually allow you bi-directional trading, so you can long and short futures, and you can garner both a bullish and a bearish view, unlike equities per se. So it allows short selling. It's simple because it tracks the index, so you don't have to monitor individual stocks, just have to monitor the general picture or the macro view, and it allows you to hedge or speculate. So as stated, you can buy and short, you can profit from both a rising and falling market. So an example is this: when you had the unexpected non-farm payroll results in February, it led to market fear, and this resulted in that day itself. So if, like example, you were to sort of like short the market, you may not know you can short the market, so you can profit from there. Alternatively, if you do not know what actually equities to short, you can just short the futures as well, because it allows you to capture the entire market movement. So why is it simple? Because you don't have to do a you do not have to study individual equities. You will just have to monitor the macro picture. So some of the factors that affect the macro picture will include just the economic data releases and the news driven by price movements, etc. So like example, in this kind of situation whereby Dow suddenly plummeted 1,032 points overnight, if it's you, which equity would you pick? Well, many people couldn't pinpoint an exact equity because some equities may rise in a falling index market as well, because they are maybe more defensive. So if you do not want to pick stocks, you can just directly short the index and can profit from the whole thing itself. So this is a very simple way to actually more simple way to actually be involved in the market itself. So it allows you to hedge and speculate also. So if, like example, you right now have stocks, you may want, if you think that right now you can use futures to hedge on it as well. Alternatively, you can just use it as a pure speculation and to be involved in the markets to short the market. So like example, in this situation, whereby if you own Amazon, what would you do? Whereby when President Trump started tweeting about negatively about Amazon, some people will say that, oh, I would short Amazon, but then if you short and if the fundamentals are good, next day rebound, you may not be able to sort of like buy back Amazon already. So what you can do is you can do a hedge position. You can actually short the futures instead, and you can profit from the futures. So the four I mentioned four US indices: the Dow, S&P, Nasdaq, and Russell, and these will be the four corresponding futures that track these four indices offered by the CME group itself. And there are also futures on currencies. So aside from US dollar, yen, or even Australian dollar, many other currency futures are being offered by the CME group as well. And for a more comprehensive list, you will be able to check it on the CME website. All right. So with that, I've come to the end of my presentation, and we'll open up the floor for Q&A. I'll pass it back to Sri. Thank you.
All right, thank you so much, Samuel, for covering very extensive coverage of various points on today's topic. Samuel, we are gonna questions right now. So if you have any questions, fire away in the question box, and we'll pick them up one by one. All right, so we have the first one from Mr. Martin Chia. For wide range market, what's the recommended cut loss points for day trading?
Okay, for the US wide range markets, the recommended points for day trading will be really dependent on the hourly chart already, and it really varies from day to day depending on the market movement. All of this usually we will use technical analysis to actually determine. So offhand, right now, I'm not actually able to tell you what is the loss, but you can look for proper indicators. Like if you're looking at the hourly charts, maybe you can use the 200 EMA as an indicator as well, or in fact the Fibonacci supports. So or like moving averages in terms of bearish cross. So all of this could be one of the indicators you are looking. Maybe with combined with multiple indicators, you will find the right cut loss point for your day trading.
All right, we have rather a number of questions from Mr. Peter. The first of which is with regards to reduction in tourism, I believe from the Chinese. How much impact is there since this is global uptrending?
All right. I mean, the impact will definitely be quite severe because Chinese tourism have actually propped up quite a number of economies already. So you can see that Chinese tourists are spending quite a lot in various countries. And if we reduce the Chinese spendings in the US itself, it could result in the economy correcting in terms of the US economic numbers. So we can look in terms of consumer spending, consumer confidence, more of like these numbers, and this will eventually actually impact the US market because like we can see that US markets this year as a whole was propped up by positive strong US numbers. So with weaker numbers, maybe unemployment rate may rise because people are not spending that much, they may not need that much jobs. So the retail sector, the may all be impacted from there. So even if it's a global uptrend, we can see that internal spendings are also very important in a country to prop up the economy. So, I mean, regardless whether it's a global uptrend, uh, if we see that US economy is being affected by numbers, and if we dwell deeper and we see that it's because of China and whatnot, it will affect the overall US index as a whole as well because companies may not earn that much.
So, in terms of another question from Mr. Peter, in terms of a hard Brexit, what are the criteria that investors should look out for? Should it be headed for a hard Brexit?
So if it's a hard Brexit, people definitely have to look out for the trade routes or trade agreements that are going to be secured from the hard Brexit as a whole. And if not, the UK will not have much ties with the other countries after hard Brexit. But the thing to note is that there may be a light at the end. There may be a light at the end of the tunnel, because right now what happens is that the European Court actually stated that the UK is able to nullify Article 50, which actually stated that Brexit is to happen. So if uh, UK really nullifies the Article 50, if they garner enough vote for that, we will see that it remains status quo, and the UK economy would start to recover from there. Because studies have been shown that even if UK were to exit based on Theresa May's terms, in terms of economy, it may not do as well as what it is currently doing. And if it's a hard Brexit, definitely a lot of industries will be impacted. The currency will face a huge sell-off, and the economy in the UK may go into a recession. So I mean, as in, everybody is trying to prevent a hard Brexit from happening. So it really depends on the negotiation process going forward.
All right. So we have a question from Mr. Lee. He mentioned that the audio was distorted earlier. I'm sorry for that, guys. Would you be able to explain briefly on neutral rates again?
Okay, so for neutral rates, what happens is that neutral rates are set by the Fed. So the Fed set neutral rates to be 3%. So right now we can see that rates are approximately 2.25%, 2.25%. So we can see that in another three rate hikes, we will hit the neutral rate levels. So when we hit the neutral rate levels, which is the level set by the Fed, what will happen is that they would need a more stringent criteria to justify their raise above that levels, which is that 3% mark. So the last time Powell actually stated that they were still quite far away from neutral rate, but right now, based on what he's stating, is that they are nearing neutral rate, and they may like to hold off, like raising rates as quickly as they did this year itself.
All right. So, Samuel, do you have any thoughts on the outlook for gold? This is a question from Mr. Viren.
All right. Unfortunately, I'm not the analyst covering gold. We have another analyst actually covering gold as a whole. But I'll talk on the dollar perspective, because we do know that gold and the dollar are always inversely correlated. So if the dollar strengthens, gold usually weakens. And right now, if the dollar is still seeing some strength, we can see the gold maybe weaken a little bit more. But when it starts to become neutralized, sort of like when it does not see so much strength, the rate hike this year, we can see that maybe gold strengthen a little bit again, a little bit. So we can see maybe gold start recovering from its low that we saw this year.
So, Samuel, what's the difference between trading currencies on our MetaTrader 5 and true CME futures?
Okay, so this will be more of a product question. So it really depends on individual. So some people prefer uh, having futures contracts, whereas some love spot forex. So the difference between MT5 and futures is that one is spot contract, one is a futures contract. So if it's a spot contract, what will happen is that things take place immediately, and you will not be able to hold the foreign currency in the long run. So like example, let's say if you we all know that MT5 is US dollar denominated, you will only be able to withdraw out sort of like a profit and loss and everything is will be in US dollars. However, if you are holding a futures contract, you'll be able to encash the opposing currency when the futures contract expire. So all of this, you'll be able to get physical delivery and hold on to. For example, if you like British pound, etc. So that is the main difference, and usually people prefer to use futures to hedge.
All right, so most welcome, Mr. Lee. Glad to clarify the neutral rates. We have one more question from Peter. Well, it's not the same criteria between FATA, and China, since US and China is competing for the first world economic position. So what's what are the criteria? What's the criteria to analyze for similar and differences?
Okay, we are not analyzing for similar and difference in terms of when I was saying the FATA and the contract. We are looking at the timeline needed to actually secure, because we can see the main difference between FATA is that there was an existing agreement and they already took such a long time. Whereas right now, if we're looking at the US and China trade, there is no backbone to begin with, and process will take much longer than 90 days. And I do agree with your point that US and China are trying to be a first world economy, but the fact is still very persistent with regards to China in terms of trade, and they have been trying to suppress China's trade. But right now, if you're looking, still quite dependent on each other. If a trade war really occurs between these two major economies, the whole world is going to suffer. So the best way is actually to strike out a fair agreement, which both parties have not been able to negotiate or agree upon, because their main views about fair trade is very different. It's the same as North Korea and US with regards to denuclearization. So when we are comparing the similarities and differences, we are mainly looking at what President Trump has and how is it going to impact his decision or his way of doing things uh, in this context, which is settling the US and China trade agreement.
All right, thank you so much, Samuel Siew. Audience as well. Samuel will return in Q1 in January the 8th. He'll be doing another market outlook focused on indices. So if you have any burning questions or you'd like to know where your trades or investments should be focused on, do not miss that upcoming webinar. Thank you for being a wonderful audience. I really appreciate the whole lot of questions we received from you. We will be sending a follow-up email. You should have a video recording so you can revise what we have covered today. All right. Thank you so much. Have a good night.